Welcome to the exercises portion of Chapter 13, Current Liabilities and Contingencies. You will see that we have approximately 15 exercises that we'll be going over, and those should help you in preparing for your homework. Okay, exercise number 1. On November 1st of year 1, Expertise Technology, a geothermal energy supplier, borrowed $8.9 million cash to fund a geological survey. The loan was made by ZE Bank Corp. Under a non-committed short-term line of credit arrangement. Expertise issued a 9-month 12% promissory note. Interest was payable at maturity. Expertise's fiscal period is the calendar year. So we have to do 3 things here. We have to prepare the initial journal entry for the issuance of the note. We have to make the adjusting entry at the end of the fiscal year. And then we have to make the journal entry for the payment of the note. So our first thing, we're going to make our journal entry for the issuance of the note. So we're going to debit on November 1st, the date that we borrowed the money, cash, that's what we received, and that's for $8,900,000. And then we're going to credit notes payable for the same $8,900,000. Okay, that should be no problem. The second thing that we have to do, however, is we have to prepare the appropriate adjusting entry. So now we're going to have to look at the interest expense, and we find that we've got 12%, so that's 1% a month, and we borrowed the money on November 1st. So we've got November and December that we have to account for the interest. So that's 2/12 times 12%, or 2%, of $8,900,000, and that equals $178,000. So on December 31st, we will make the adjusting entry of interest expense for a debit of $178,000, and we will credit interest payable for the same $178,000. The final thing we have to do on this exercise is to show the payment of the note at maturity. Okay, so the first thing we're going to have to do is we will have to record the interest that we have not accumulated, and so that will be the 7 months until the note is payable, and so that will be 7/12 times 12% times the original face amount of $8,900,000, or $623,000. So on July 1st of this year, we're going to debit interest expense for $623,000. We will also debit interest payable for the original $178,000, and then we're going to also debit notes payable for the original $8,900,000. And our credit is going to be the cash for all 3 of those combined, and so that will be $9,701,000. Okay, our next exercise is exercise number 3. We have a selected group of transactions that relate to the liabilities of Natural Gas Corporation. Natural's fiscal year ends on December 31. And what we're required to do is prepare the appropriate journal entries through the maturity of each liability. And so we see here we have on January 13th, we negotiated a revolving line of credit with Z Bank that can be renewed annually upon bank approval. The amount available under the line of credit is $25.1 million at the bank's prime rate. On February 1st, we arranged a 3-month bank loan of $5.02 million with Z Bank under the line of credit arrangement. So we're tapping that credit arrangement that we had for $25 million. We're only using about $5 million, a little over $5 million of it. Interest is at the prime rate of 10% and is payable at maturity. On May 1st, we paid the note, and we paid the interest on that. And December 1st, supported by the line of credit, we issued $12.55 million commercial paper on a 9-month note. interest was discounted at issuance at a 9% discount rate. Now, notice here that this is going to be a little bit different. We are discounting the interest, and then on the 31st, we record any necessary adjusting entries. And then September 1st of this next year, we pay the commercial paper at maturity. Okay, so year one, the first thing that we do, we negotiate the revolving line of credit with Z Bank. Now, no entry is going to be required here. Why? Because nothing has actually transpired. We have agreed to something, but we have not actually borrowed the money yet. We've agreed to be able to borrow the money, but we have not actually borrowed the money. So no journal entry is required. Then on February 1st, we actually borrow. So now this time we're going to have to make a journal entry because we actually borrow the money, $5.02 million, with a 10% payable at maturity. This is a 3-month bank loan. So we're going to debit our cash for $5.02 million, and we will credit notes payable for the same $5.02 million. Okay, that's all that's done in there. Now, on the next entry, we're going to pay this back. This is May 1st, so it's 3 months later. So we're going to take the $5.02 million times the 10% times 3/12 of a year. Okay, so 3 months we use it, but the interest rate of 10% is for a full year. We only use the money for 3 months, so we don't pay the full 10%. We pay 3/12 of the 10%. And so that's going to equal an interest charge of $125,500. Okay, so we make our journal entries now of interest expense of $125,500. We're also going to debit notes payable for the original $5,020,020, and then we're going to credit cash, and that's going to be for the sum of that, which will be $51,455,000. All right, so that takes care of our payment on the line of credit. Now, we're going to use the line of credit as guarantee to issue commercial paper on a 9-month note. And you'll notice the reason that we're doing that is because we borrow from the bank at the prime rate of 10%, but we can issue this note at 9%. So we're going to save a little bit of money by going through and issuing the note. But the line of credit is going to guarantee that these people get their money back. Okay, so if we can't come up with the money by the due date, which is 9 months from now, then we're just going to borrow it from the bank, and we'll have to pay a higher credit rate at that time. Okay, so the first thing we have to do is figure out the interest rate. Remember, this one is discounted, so we're going to basically not receive the full amount of interest. It's going to be for 9/12 of the year, 9 months out of 12 months of the year. So we're going to have $12,550,000 times 9% times 9/12 of the year is going to be $847,125. That will be reduced from the amount that we receive. So our journal entry is going to be for the 12 million. We're going to debit cash for 12,550,000 minus the 847,125, and that's going to be discounted. And then the notes payable will be the full amount, but we have to have the credit of $11,702,875. So what we're going to pay at maturity on a discounted note is the full face value. It won't be face plus interest. Interest is taken off up front. Now what that actually does is it actually increases that interest rate a little bit because you're not getting to use the full $12,550,000. You're only getting to use $11,702,875. So that's how we do this type of an entry. Okay, now at the end of the year, we have to make any adjusting entries. Okay, so our interest expense on the 12,550,000 times 9% times 1/12, right? Because by the end of the year, we've only used the money for 1 month, will be 94,125. And so here we're going to debit interest expense for 94,125, and we're going to credit the discount on notes payable for 94,125. Finally, the last entry we make on this one is that we pay the commercial paper at maturity. Okay, so we're going to pay the full 12,550,000. So that's going to be cash out. So that's going to end up being our credit at the bottom of this entry. Then we're going to have have the discounts on notes payable. And so that will be for the full amount of the discount minus the 94,125 we've already recognized as interest expense. And then the difference will be the interest expense. Okay, so we see the interest expense is calculated as the 8 months remaining. Remember, we used 1 month of the period last year. We're using 8 months of the period this year. So 12,550,000 times 9% times 8/12 is $753,000. So the first thing we're going to do is debit interest expense for $753,000. And then we're going to have our discounts on notes payable is going to be for that same $753,000. That'll be a credit. And then we're going to have credit the notes or debit the notes payable for $12,550,000, and then we're going to credit cash for $12,550,000, and that takes care of both the interest and the principal on this commercial paper. All right, exercise number 5. On January 1st, year 1, Tyler Corporation agreed to grant its employees 2 weeks vacation each year with the stipulation that vacations earned each year can be taken the following year. For the year ended December 31st of year 1, Tyler's employees each earned an average of $800 per week. 600 vacation weeks earned during year 1 were not taken during year 1. Prepare the appropriate adjusting entry for vacations earned but not taken in year 1. And 2, suppose that by the time vacations are actually taken in year 2, wage rates for employees have risen by an average of 5% from their year 1 level. Also assume that wages earned in year 2, including vacations taken in year 2, were $25 million. Prepare the journal entry that summarizes the year 2 wages and payment for year 1 vacations in year 2. Okay, so the first thing we have to do is make the appropriate journal entries for the vacations that were not taken in year 1. So we've got 600 vacation weeks times $800 per week is going to be $480,000. So our journal entry, our adjusting entry on December 31st is going to be wages expense. This is just calculated as part of the expense that we pay people for $480,000. And we will have a liability for compensated future absences of $480,000, and that takes care of our adjusting entry. All right, now in year 2, we're going to have wage rates that have increased by 5%, and also assume that wages earned in year 2 are $25 million. So prepare the journal entry that summarizes that one. Okay, so we take our wage expense of $25 million plus 480,000 times 5% will be $25,024,000. That's the 24,000 comes from the 480,000 last year times the 5% increase that occurred this year. Okay, so our journal entries are going to be a liability for future compensated absences. This removes last year's liability of $480,000. We then have wage expense of $25,024,000. So that's the wage expense of $25 million plus the extra $24,000 from vacation accrued last year but taken this year and paid at this year's rate. We then use cash or wages payable of $25,504,000. That's to record the 2-year amount. Okay. Okay, exercise number 7. Dolbius Semiconductors sells perishable electronic components. Some must be shipped and stored in reusable protective containers. Customers pay a deposit for each container received. The deposit is equal to the container's cost. They receive a refund when the container is returned. During year 1, deposits collected on containers shipped were $895,500. Deposits are forfeited if containers are not returned within 18 months. Containers held by customers at January 1st, year 1, represent deposits of $597,000 in year 1. $832,815 was refunded, and deposits forfeited were $36,716. What we need to do here is prepare the appropriate journal entries for the deposits received and returned during year 1. And then number 2, determine the liability for refundable deposits to be reported on December 31st of year 1 balance sheet. All right, so the appropriate journal entries for the deposits received and returned during year 1 are: we're going to have cash of $895,000. That's the amount that we collected on the deposits in the first place. Okay, and then we're going to have the liability refundable deposits. That's going to be our offsetting credit. Then we're going to debit the liability for refundable deposits. That's what we obviously paid back to them. And then the that will be cash that we actually paid to when they return those. Finally, we're going to have liability refundable deposits of $36,716, and those are forfeited, so that becomes revenue. Now, it was a liability because we owed it to it, but after a certain period of time, it becomes revenue. Now, I want you to make note of this because this also is how we treat things like gift cards. Somebody pays us cash as a merchant, we give them a gift card, they give it to somebody, and for a while it's a liability. At some point, it's no longer redeemable and it becomes a revenue. Okay, so our cost of goods sold is $36,716, and our inventory on containers. That assumes that the deposit on containers are at the actual cost, which is reasonably common. Then the second thing that we have to do is to determine the liability for refundable deposits to be reported December 31st, year 1 balance sheet. Okay, so we've got the balance sheet is $597,000, and the deposits received were $895,500. The deposits returned were $832,817. The deposits forfeited were $36,716. So we just sum all those up, and our balance to be reported on the balance sheet is $622,969. All right, we now go to exercise number 8. The following selected transactions relate to the liabilities of Granoli Farm Products for December of year 1. Granoli's fiscal year ends December 31. And here's our transactions. On December 15th, We received $8,000 from Brindle Farms towards the purchase of $92,000 tractor to be delivered January 6th of year 2. During December, we received $27,000 of refundable deposits relating to containers used to transport equipment parts. And 3, during December, credit sales totaled $820,000. The sales tax rate is 4% and the local sales tax rate is 2%. So that's a total of 6%. This is a summary journal entry for the many individual sales transactions for the year. Okay, so our first entry that we're going to have to do is to receive the $8,000 deposit towards the purchase of $92,000 tractor to be delivered January 6th. So on December 31st, we're going to receive cash, so we debit cash of $8,000 and we credit deferred sales revenue. Now this is one of those accounts that even though it says sales revenue, it is actually a liability, because if we don't perform and deliver the tractor, we're going to have to return that. So this is actually a liability, even though its name would imply sales revenue. Okay, the second entry that we have is the receipt of $27,000 of refundable deposits. This is going to be similar to our previous exercise entry. And then we're going to have cash of $27,000 that we took in, and then we're going to have refundable deposits as a liability for $27,000. Our third entry during the year is going to be credit sales of $820,000, and we have a sales tax rate, state sales tax rate of 4%, local rate of 2%. Okay, so we figure out the total, that's 6% times 820,000 or $49,200. So now we're going to have sales revenue of $820,000, and that's going to be a credit. And then we're going to have it's going to be credit sales, so it's going to be, we're going to have the sales tax payable for $49,200. Then we're going to have accounts receivable, and that will be the sum of those, or $869,200 will be our debit, our initial debit. Okay, exercise number 9. Emotive Q commenced a gift card program in January of year 1 and sold $13,000 of gift cards in January, $17,000 in February, and $17,000 in March before discontinuing further gift card sales. During year 1, gift card redemptions were 7,000 of the January cards sold, 3,500 of the February cards, and 5,000 of the March cards. Emotive Q considers gift cards to be broken, in other words, not redeemable, 10 months after the sale. How much revenue will Emotive Q recognize with respect to the January gift card sales during year 1? Now, then 2, prepare the journal entries to record the sale of January gift cards, redemption of gift cards, ignore any sales tax, and breakage, or the expiration of gift cards. 3, how much revenue will Emotive Q recognize with respect to the March gift card sales during year 1? And 4, what is the liability for deferred revenue associated with gift card sales would they show as of December 31st of the year? All right, so the first thing we have to do is how much revenue will Emotive Q recognize with respect to the January gift card during the year? This is a little bit of a tricky question. They sold $13,000 worth of gift cards in January, and they ended up with 7,000 in redemptions. But remember, they consider them broken 10 months after the sale. So we're actually going to end up with all 13,000 being recognized as revenue. So we had the 7,000 worth of redemption We had 6,000 worth of expiration, so we end up with a total of 13,000 that was revenue for the year. That's the total sold. Okay, so the second thing we have to do in this problem is to prepare the journal entries to record the sale of the January gift cards, the redemption of the gift cards, and the breakage of the gift cards. So on year one, we're going to have cash of $13,000. That's the gift cards that we sold. And we're going to have deferred gift card revenue of $13,000. Okay, the second thing we have is to record the redemption of gift cards. We remember those are 7,000. So we take that out of deferred gift card revenue of 7,000, and we're going to credit revenue gift cards of 7,000. And then finally, we're going to have the breakage of the gift cards for 6,000. So we're going to take it out of or debit deferred gift card revenue, and we're going to credit revenue gift card breakage or gift cards, this account. Okay, so that takes care of our second entry. Our third entry here, how much revenue will they receive with respect to the March gift card sales? Now this one's a little bit different because March expires, right? March is the third month, and so on December 31st, any gift cards not used are still available to be used for one more month. So in this case, we sold 17,000 worth of gift cards. However, we redeemed only 5,000 of the March cards, and none of them are broken. So therefore, $5,000 will be recognized as revenue because of the gift card redemption. The 12,000 remaining will not be broken until January 31st. Finally, what is the liability for deferred revenue associated with gift card sales that a motive Q will show as of December 31st of the year? Okay, since these gift cards all expire within 10 months, everything sold in January will either be redeemed or expire. Everything sold in February will be redeemed and expire. We've got 17,000 in March that were sold. However, 5,000 was redeemed. Therefore, we're going to have a deferred revenue of $12,000 still remaining. Okay. All right, exercise number 15. DuPont Awning Corporation introduced a new line of commercial awnings in year one that carry a 2-year warranty against manufacturer's defects. Based on their experience with previous product innovations, warranty costs are expected to approximate 2% of sales. Sales and actual warranty expenditures for the first year of selling the product were $4,361,000 in sales, and the actual warranty expenditures were $21,805. Does this situation represent a loss contingency? Why and why not? And how should DuPont account for it? 2. Prepare the journal entries that summarize the sale of the awnings, assume they're all credit sales, and any aspects of the warranty that should be recorded during year one. And 3. What amount should DuPont report as liability on December 31st of year one? All right, does this represent a loss contingency? This is a loss contingency. There may be a future sacrifice of economic benefits, the cost of satisfying the warranty, due to an existing circumstance. The warranted awnings have been sold. That depends on an uncertain future, the customer claims. The estimated warranty liability is credited and warranty expense is debited in year one, the period in which the products under warranty are sold. All right, number 2, prepare the journal entries that summarize the sale of the awnings, assume they are all credit sales, and any aspects of the warranty that should be recorded during year one. Okay, the first thing we're going to do is we're going to debit accounts receivable. They were all credit sales for $4,361,000, and we're going to credit sales revenue for the same amount, or sales in this case for the same amount. Okay, but then we have to take into account the warranty expense. Okay, and so we're going to have the warranty expense that we recognize at the time of sale, and then we're going to have to take care of the warranty claims that were actually processed. So the first thing is going to be the warranty expense, and remember that was 2% of our sales, so 2% of $4,361,000. So the warranty expense is going to be $87,220. That's 2% of the $4,361,000. And we're going to credit warranty liability during the period, estimated warranty liability for $87,220. Now, however, we actually had customer claims for $21,805. That's going to come out of the estimated warranty liability, not an additional warranty expense. So we're going to take the $21,805 out of estimated warranty liability, and we're going to make it cash as wages payable, whatever it took to fulfill that particular warranty. Sometimes it's somebody working on something, sometimes it's a refund, sometimes it might be parts to fix something, or sometimes it may be a little bit of all of that type of thing. So whatever the appropriate account is, that we will credit that. And 3, what amount should DuPont report as a liability December 31st of year 1? Well, we're going to assume that they're still good with that 2% figure, and so it's going to be the full amount of the liability, the estimated liability of $87,220 minus what has already been redeemed, or claims of the customers that we had in that first year. And so our balance is going to be the $65,415. Okay, exercise number 17. Rex Audio manufactures and sells audio equipment for automobiles. Engineers notified management in December of year 1 of a circuit flaw in an amplifier that poses a potential fire hazard. An intense investigation indicated that a product recall is virtually certain, estimating to cost the company $3 million. The fiscal year ends on December 31st. Should this loss contingency be accrued, only disclosed, or neither? Explain. What loss, if any, should Rex Audio report in its year 1 income statement? 3. What liability, if any, should Rex Audio report on the year 1 balance sheet, and prepare the journal entry as needed? Okay, should this loss contingency be accrued, only disclosed, or neither? This should be accrued. This is a loss contingency. Remember, it said it is virtually certain because it is probable the confirming event will occur and the amount can be reasonably estimated. We have both conditions. Probable, virtually certain is even more than probable. So, and it is reasonably estimated at $3 million. So it should be close. Okay, so if neither is probable or reasonably estimated, we would only disclose it. Okay, number 2, what loss, if any, should Rex Audio report in the year 1 income statement? It should report the $3 million loss contingency. That's virtually certain. The balance sheet should show a liability of $3 million. And the journal entry would be loss on product recall of $3 million, and then liability of product recall of $3 million. Exercise number 18. The Fimaware Company uses the allowance method to account for bad debts. At the beginning of the year, the allowance account had a credit balance of $66,844. Credit sales for year 1 totaled $2,139,000, and the year-end accounts receivable balance was $436,713. During this year, $65,061 in receivables were determined to be uncollectible. FimAware anticipates that 4% of all credit sales will ultimately become uncollectible. The fiscal year ends on December 31st. Number 1, does this describe a loss contingency? Explain. 2, what is the bad debt expense FimAware should report in its year 1 income statement? 3, prepare the appropriate journal entry to record the contingency. And 4, what is the net realizable book value that FimAware should report on its year 1 balance sheet? Okay, does this describe a loss contingency? Yes, this is a loss contingency. This is a bad debt. So when resolved, non-cash assets being impaired, so accruing it means reducing the related asset rather than recording a liability. The most common loss contingency is uncollectible receivables as described in this situation. 2, what is the bad debt expense that FimAware should report in its year 1 income statement? Okay. They had credit sales for the year times 4%. So they had credit sales of 2,139,000 times 4%, and that's going to equal 85,560. Prepare the appropriate journal entry for the year 1 for the contingency. Okay, so we're going to have bad debt expense for 85,560, and then we're going to have allowance to uncollectible accounts for 85,560. Now notice here that the allowance account had a credit balance of 66,844. Why did we not use that at this point? Because we use that when we use the aging of accounts receivable method. This was this we are using the total credit sales method to estimate our bad debt, and so those are two different methods. If we had used the aging of accounts receivable method, we would have used the credit balance in this to help figure that, but we did not. Okay, what is the net realizable book value that FimAware should report in its balance sheet? Well, it's going to be the new allowance for bad debt, allowance for uncollectible accounts. The beginning of the year, we wrote off bad debts for 65,000, leaving us a credit balance of 1,783. We have an accrual at the end of the year of 85,000, and so at the end of year 1, we have 87,343. The net realizable value will be the accounts receivable minus the allowance for uncollectible accounts, and so a net realizable value of 349,370. And realize that when we show the balance sheet of most companies in their financial statements, they don't show this whole amount of accounts receivable less allowance for accounts in the financial statement. That'll be off in the footnote somewhere, but they'll just show the net realizable value. And it usually is listed as accounts receivable parentheses net. Exercise 19. On April 1st of year 2, the Food and Drug Administration is in the process of investigating allegations of false marketing claims by Reno Food Supplements. The FDA has not yet proposed a penalty assessment. Reno's fiscal year ends on December 31st of year 1. The company's financial statements are issued April of year 2. Okay, for each of the following scenarios, determine the appropriate way to report the situation. Explain your reasoning and prepare the necessary journal entry. Okay, management feels an assessment is reasonably possible, and if an assessment is made, the unfavorable settlement will be $10 million is reasonably possible. Management feels the assessment is reasonably possible, and if an assessment is made, an unfavorable settlement of $10 million is probable. Management feels an assessment is probable and that the assessment is made, an unfavorable assessment of $10 million is possible. And number 4, management feels the assessment is probable, and if the assessment is made, an unfavorable settlement of $10 million is probable. So here we have basically a 2-by-2 matrix where the assessment is possible or probable, and the amount is possible or probable. Okay. So in the first case, management feels that the assessment is reasonably possible and the assessment is made, $10 million is reasonably possible. No disclosure is required because the FDA claim is unasserted and an assessment is not probable. Okay. Number 2, management feels that the assessment is reasonably possible and if the assessment is made, $10 million is probable. Okay, again, no disclosure is required because the FDA claim is unasserted and is not probable, even if the unfavorable outcome is thought to be probable in the event of an assessment. The amount is estimable. Disclosure is not required unless an unasserted claim is probable. Okay, number 3, management feels that an assessment is probable and that the amount is reasonably possible. So this time, a disclosure note is required because the FDA claim is unasserted but is probable. Notice the first two, the FDA claim was possible. Now it has upgraded to probable, and so we have to disclose it. However, since the amount is not probable, then it's only a disclosure note that is required. And then finally, number 4, we have to accrue the loss because the FDA claim is unasserted but is probable, and the amount that it will be is probable. And so now we need to make an accrual. Okay, exercise number 21. The following selected circumstances relate to pending lawsuits of Gladius Inc. Gladius fiscal year ends on December 31st. Financial statements are published in March of year 1, and Gladius prepares the financial statements according to U.S. GAAP. Indicate the amount of asset or liability that Gladius would record and explain your answer. 1. Gladius is defending against a lawsuit. Gladius's management believes the company has a slightly worse than 50-50 chance of eventually prevailing in court, and if it loses, the judgment will be $2 million. Situation 2. Gladius is defending against a lawsuit. Gladius's management believes it is probable the company will lose in court. If it loses, management believes that damages could fall anywhere in the range of $3 million to $6 million, with any damage in that range equally likely. Number 3. Gladius is defending against a lawsuit. Gladius's management believes it is probable that the company will lose in court. If it loses, management believes the damages will eventually be $8 million with a present value of $454,500,000. Gladius is a plaintiff in a lawsuit. Gladius's management believes it is probable that the company will eventually prevail in court, and if it prevails, the judgment will be $2 million. And Gladius is the plaintiff in a lawsuit. Gladius's management believes it is virtually certain that the company will eventually prevail in court, and that if it prevails, judgment will be $550,000. So, our first one, we have that it is slightly worse than 50-50 chance of prevailing in court, and if we lose, it's going to be $2 million. Okay, we would not recognize a liability, as GAAP defines probable to be the likelihood substantially more likely than not. Rather, Gladius would view the loss as reasonably possible and provide a disclosure note. Number 2, here we have that it is probable that the company will lose in court, and then we have a range between $3 and $6 million, with any damage in that range equally likely. Gladius would recognize the liability of $3 million as it is probable that they will lose in court. U.S. GAAP requires the accrual at the low end of the range of equally likely outcomes. There will also be a disclosure note. Number 3, this is where we believe it is probable we will lose in court, and the management believes the damages will eventually be $8 million with a present value of $450,000. We would recognize a liability of $8 million as it is probable we will lose the case. Under GAAP, companies do not discount litigation. Note, they do under IFRS. Right? You record the present value under IFRS. There is also a disclosure note that will be made for the lawsuit. Number 4, we're the plaintiff. In other words, we're suing somebody else, and it is probable that we will eventually prevail in court. The judgment will be $2 million. We never have a gain contingency. We do not accrue gains under U.S. GAAP. Gladius is the plaintiff in a lawsuit. Once again, we're suing somebody, and we're virtually certain we're going to win, and the judgment will be $550,000. Again, this is a gain contingency. We do not use gain contingencies under U.S. GAAP. Exercise number 22. The following selected circumstances relate to pending lawsuits for Gladius Incorporated. Fiscal year ends on December 31st and financial statements are published March of year 1. Gladius prepares its financial statements in according to IFRS, International Financial Reporting Standards. For each circumstance, indicate the amount of asset or liability that Gladius would explain. Okay, so this is basically the same problem that we just did before, except the rules are under IFRS instead of under U.S. GAAP. Okay. So number 1, we have a slightly worse than 50-50 chance prevailing in court, and the judgment will be $2 million. We would recognize a liability of $2 million. IFRS uses a more probable than not. So worse than 50-50 is more probable than not. And so they need to record the liability of $2 million. In this case, they believe it is probable and that it will be in a range of $3 to $6 million. Okay, so what we do under IFRS is we record the midpoint of the range. Now, the fact that we record it is the same as GAAP. However, under U.S. GAAP, we would have only recorded the $3 million. Here we record the mid-range, the $4.5 million. Here we have we're probable that we'll lose with an eventuality that the damages will be $8 million and the present value of $4,500,000. We would recognize that $4,500,000, as I explained in the last one, as it is as we use present value accounting under IFRS. Number 3, we're the plaintiff in a lawsuit and we believe it is probable that we'll win. The judgment will be $2 million. And the gain contingencies are accrued when it's virtually certain under IFRS. However, this is only probable, then it would not be recognized. And finally, we have a gain contingency that is virtually certain, and so under IFRS, we would accrue the $5,500,000. Exercise number 24. Flora Lawn Products introduced a new line of commercial sprinklers in year 1 that carry a 1-year warranty against manufacturer's defects. Because this was the first product for which the company offered a warranty, trade publications were consulted to determine the experience of others in the industry. Based on that experience, warranty costs were expected to approximate 3% of sales. Sales of the sprinklers in year 1 were $2 million. Accordingly, the following entries relating to the contingency for the warranty cost were recorded during the first year of selling the product. So the warranty expense is $60,000, which is 3% of $2 million. So we're going to debit warranty expense and credit estimated warranty liability. The actual expenditures were $25,000. And so we're going to debit the estimated warranty liability, and we're going to credit whatever it takes, cash for a refund, wages payable to fix something, or a part to repair something. Okay, late in year 2, the company's claims experience was evaluated, and it was determined that the claims were far more than expected, 5% of sales rather than 3%. So, assuming that the sales of sprinklers in year 2 were 3.2 million and warranty expenditures in year 2 totaled 90,000, prepare any journal entries related to the warranty. And 2, assuming sales for the sprinklers were discontinued after year 1, prepare any journal entries in year 2 related to the warranty. Okay, assuming sprinklers in year 2 were 3.2 million and warranty expenditures in year 2 were 90,000, prepare any journal entries with regard to the warranty. So we're going to have 3,200,000 times 5%, or 160,000. Okay, so our warranty expense will be $160,000 debit and estimated warranty liability of $160,000 to accrue the liability expense. We also had claims of $90,000, so we'll take it out of the estimated warranty liability of $90,000, and we will debit the cash wages payable for whatever we expended to satisfy those claims. Then number 2, we're going to assume that the sales of sprinklers were discontinued after year 1. We're going to prepare any journal entries. Okay, so we had the 60,000 minus the 25,000 is $35,000. However, we have a 2% difference. We found out it's going to be 5% rather than 3%. So we have a a 2% difference on $2 million. That's $40,000 that we'll have to add to that. And so we're going to have wages, cash, parts payable, whatever, for 75,000. So now our journal entry is going to be estimated warranty liability of 35,000, loss on product warranty of 40,000, and then whatever it took to satisfy it, cash, wages payable, parts, whatever, of $75,000. Okay, exercise number 25. The Commonwealth of South Carolina filed suit October 1st of year 1 against Sullivan Timber Corporation, seeking civil penalties and injunctive relief for violations of environmental laws regulating forest conservation. When the year 2 financial statements were issued in year 3, Sullivan had not reached a settlement with state authorities, but legal counsel advised Sullivan Timber that it was probable the ultimate settlement would be $1,793,000 in penalties. The following entry was recorded: $1,793,000 lost litigation, and a liability of $1,793,000. Late in year 3, a settlement was reached with state authorities to pay a total of $1,075,800 to cover the cost of the violations. We want to prepare any journal entries for the change and briefly describe the steps that they should report to report that change. So prepare any journal entries. We're going to have the liability litigation. The difference is $17,200. And so we're going to debit liability litigation for $717,200, and we're going to have gain on litigation. We don't back out the loss, we put the gain on litigation because we already recognized the loss. Okay. And then number 2, it says briefly describe the other steps that Sullivan should take to report the change. We need to make a disclosure note to affect the change in estimate on income before extraordinary items, net income, and related per share amounts for the current period. Okay, our final exercise, number 27. Ultra Financial Services pays employees monthly. Payroll information is listed below for January of year 1, the first month of Ultra's fiscal year. Assume that none of the employees exceeded any relevant wage base. Okay, so the salaries were 500. Oh, what they're talking about by the exceeded any wage base is that there is a cap, and it's a floating cap, so it changes every year. So it's not something you want to memorize unless you're in the payroll department. But it's around 118,000 for Social Security, and so after an employee hits 118,000, both the employee and the employer no longer have to pay the Social Security part. They still have to pay the Medicare tax rate um, and stuff. And then there's federal unemployment tax rate. That's actually low. It would be kind of difficult to believe that they didn't exceed that. I think it's only $9,000 on the federal unemployment. So, but this is a textbook problem. Um, so we've got salaries of 519,000, federal income taxes withheld 103,800. The federal unemployment rate is 0.8%. The state unemployment rate is 5.4%. The Social Security tax rate is 6.2%, and the Medicare tax rate is 1.45%. And we need to prepare the appropriate journal entries for this. Okay, so we're going to have salaries expense for the full $519,000. We're also that's going to be our debit. Our credit is going to be for withholding taxes payable for the withholding taxes, federal income taxes. Those are trust fund taxes that we owe to somebody else, federal government in this case. We're going to have the unemployment tax rate. That'll be 8% of the 519,000. Oh, I'm sorry, the Social Security they're going to put first here is 6.2% of the 519,000, 32,168. We're going to have the Medicare taxes, 519,000 times 1.45, or 7.526 on that. We're going to have salaries and wages payable of $375,496. That's right. I was going to do the federal and state unemployment, but that's not paid by employees. That's paid only by the employer. So we're going to have Social Security taxes payable because the employer has to match that for the employee. So that's going to be the same 32,178. So the federal government is going to get both of those, the amount from the employee plus the amount from the employer. So they're going to end up with a little over 64,000 on Social Security taxes. We're going to have the Medicare taxes payable. Again, that's a match by the employer. Then the unemployment taxes will be 4,152. That's 8% of the 519, and the state unemployment tax is 5.4% of the 519,000. So that records our payroll taxes, and that total comes to 71,882. All right, this concludes our exercise examples. And so good luck with your homework, and please get hold of me if you have any problems doing that.